Hello, good afternoon, and welcome back, everyone. Welcome to the first in the autumn series of BKL webinars. This is Anthony Newgrosh back in the chair again today, and I'm delighted to be joined by two learned colleagues today. I've got David Rubin from Postlethwaite. Good afternoon, David.
Afternoon.
David is an expert in employee share option arrangements and share schemes, as I'm sure he'll enlighten us further today, and also, dare I say, supporter of some of the world's worst football teams. What is it? Barnet, Bradford and Arsenal will include in that. Yep. And also joining us today is my colleague Daniel Shear, corporate finance partner here at BKL and supporter of another rubbish football team, but maybe we'll stick to tax today. Hello, Daniel.
Hi.
So today, I'm delighted to say thank you, David, first of all, for joining us. We're talking about employee share ownership trusts. Relatively new beasts, been around since 2014. But slowly gaining traction, I think it would be fair to say.
Yeah, that's right, Anthony. These things have been around since 2014. There are now around 300 in the UK. There have always been quite a few employee-owned companies. John Lewis is the example that everybody gives. And although the legislation was only brought in 2014, there are quite a few companies like John Lewis, I think, that are sort of grandfathered for the purposes of the regulation. So if someone says, oh, we became employee owned in 2008, don't say, ha ha, that must be wrong because it only came in 2014. So one thing that people often say is, oh, we don't want to have anything to do with EBTs. EOTs are a form of EBT. We've had all sorts of problems with our EBT and remuneration planning in the past, in the same sort of way as sort of bankers and footballers often did. This is a completely different type of employee trust. It does have statutory backing, so even companies that have had difficulties with EBTs in the past shouldn't allow this to put them off employee ownership trusts.
And we should add, I mean, EBTs have been used for somewhat nefarious purposes in the past, but they still do have legitimate places in tax planning, be it for warehousing shares as part of an EMI scheme, etc., etc. That's for another day, but today we're just going to focus on these employee ownership trusts. And I think we've got examples of the sort of companies that have put these arrangements in place, David.
Yes, that's right. So there are some examples here. As we said, over 300 companies now in employee ownership, and going up sort of by 20 or 30 a month. We sound so it is a popular way forward. In terms of high profile, many of you will have seen the Richer Sounds transaction. There's also Hodge, Jones and Allen, who are solicitors. Quite a few accountants are looking at this at the moment as well, and we think it is a popular way forward at the moment, and certainly if the tax rates go up, it'll become more popular, I suspect.
I think you're right, and well, we're not here to do politics, as it were, but I think it'd be fair to say we're in fairly uncertain times at the moment, and the tax advantages may only increase, but we'll look at that in a minute. Now, we'll start to delve into the details in a second, just to say thank you all for coming on board. If you do have any questions, do feel free to type away. By the wonders of modern technology, they will appear on our screen, and we'll try to deal with as many of those questions as we can, either during the webinar or we'll pick them up afterwards. And when we send around a copy of the slides and this presentation afterwards, we can append responses to those. Our contact details are also at the end of this presentation. Well, most of our contact details, sorry, Daniel, are at the end of this presentation. So we will try and respond personally if appropriate as well. So do type away, but let's get in there, as it were. Let's start, David. Give us the headlines. You mentioned two tax reliefs. What are those?
So there was a capital gains tax relief, and the point of that was to encourage sellers to sell to an employee ownership trust and not have any tax to pay. Now, without this legislation, they would have had a 10% tax rate. And you might say, well, 10% rather than 0% rather than 10%, does that really make there's a huge difference. But bear in mind that the 10% would be on the full amount. So if you sell for £10 million, you'd have £1 million to pay as soon as the transaction had completed, even if you'd actually only received the first instalment of 2 million. So while it doesn't sound like an enormous difference, it does in fact make quite a big practical difference.
Yeah, we're assuming when we talk about 10%, we're talking about entrepreneurs relief being available.
Yes.
And as we'll see again when we delve into detail, one would expect that ER would be available for these companies. These are trading companies we're talking about. But there may be cases where you've not owned the shares for long enough, or you may not have, for whatever reason, stupidly registered as a director, etc., etc. So although, yes, I'd expect 10, it could be 20 in certain circumstances. And come October the 15th or 16th, depending on which paper you read, it might be an awful lot more.
Correct. And it's also possible that because of the way the company's been run, for example, if the company's not paid dividends for 10 years, it might be. It might even be that the government would look to tax you to income tax on the sale. It would be much more difficult to get clearance to get clearance from HMRC in respect of the transaction.
Okay, and we'll come back. We'll talk a little bit more about the clearance mechanism later. So headline is disposal can be done free of CGT. That's good news. And should we just headline up the other key tax benefit here at this point, David?
Yeah, so the other benefit is for employees. Employees can receive up to £3,600 per year tax-free bonus. And that's obviously depending on how much money they're making, that might be a more or less significant figure. But there are very few people who would turn their noses up at that.
Yeah, it's something for nothing, really, isn't it? Why not? Long gone are the days of, was it £3,000 used to get profit-related pay?
Exactly.
You'll remember that day, but that went out, I don't know.
Yes, exactly, because people used it for service companies, didn't they? I think it was about 1998 that was abolished.
Yeah,
that's right. But that's quite a useful amount to be paid, and it's significant for many employees.
Okay, so that's the headline as to the sort of tax breaks we're talking about here. Let's just delve a little bit more deeply here. When are these arrangements most likely to be appropriate, David?
So these are often used as an alternative, because to be honest, I think everybody would like to be offered £10 million or whatever amount in cash and just be able to to walk away. I think in the ideal scenario, that's what an awful lot of people could do. But actually in the real world, that doesn't often happen, particularly in the sort of people businesses that are often involved here. It's quite unusual to be offered a very substantial amount of cash for nothing. Often there's a certain amount of cash offered up front, and after that it's a matter of remaining with the business for 2 or 3 or 4 years or whatever, and the rest of the cash will come to you conditionally upon upon the sellers being involved. And often business owners complain that they've been operating more or less without a business plan for the last 25 years. It's been their company, why do they care? But the proposal from the potential buyer is that they do actually have to do all sorts of things. They've got to answer to the head of the buyer's organisation, things like that, and they don't really want to do it. So that's an example of a third-party purchaser who's not compatible with their business.
And indeed, this assumes you can find a purchaser.
Exactly. Yeah, exactly. That's assuming you can find a third-party purchaser. Another point, because we do quite a few of these for construction companies, for example, is that often the person who's in charge of the construction company is the person who brings the work in, and nobody's prepared to buy the company because they think that this person will just take the money, emigrate, and that'll be it. There'll be no business.
Yeah, absolutely. And that's when you need a good corporate finance partner. We've got Daniel Shear, but Daniel, you got anything to add at this point about when you're looking to sell these companies? How can we help?
Yeah, I mean, we in our corporate finance team, we do offer lead advisory services. So, we can help owners of businesses that wanting to sell to find buyers. It's interesting times at the moment. Banks are not as generous, shall we say, as they once were in terms of lending to back deals. There's pressure on prices, and certainly at the moment in the current economic climate, and I guess we should say current political climate as well, it's not always easy to find a desirable buyer for a business. So we are also seeing more businesses turning owners of businesses turning to selling to an EOT because they can't find any suitable buyer. There might be other buyers out there, but not a suitable buyer.
Okay, so I think there's sort of a common message there, and I think the point you alluded to on the slides there, David, is often it's the employees who most cherish and know how to run this business going forward, and that's the most appropriate place of ownership for this business in the absence of often the key driver, as you've referred to, and the previous owner.
Yeah, absolutely. I mean, sometimes the issue is that people are concerned for the employees. They're worried that whoever was going to take them over is going to make a lot of employees redundant, and they feel some sort of obligation, reasonably enough, to their employees going forward. I mean, there was a company we were advising a couple of years ago where they were the biggest employers in the village. Even when the owner took his millions of pounds, he wasn't going to move out of the village. Everyone knew where he lived, and the last thing he wanted was for half the workforce to be sacked and for them to turn up knocking at his door and complaining about it.
I'd have moved if I was him, I think.
well, exactly. So there was some so obviously some people have issues with the potential third-party purchaser. Also, as Daniel said, often it's difficult to find funds to invest. And also, traditionally, or maybe 20 years ago, you could have had small IPOs. But I think the issue with that now is that even companies that are listed on AIM, if there's very thin market trading, there are an awful lot of associated costs, and it's really not worth anyone's while to do it unless it can hit the sort of critical level, which many companies, and particularly family-owned businesses, aren't going to achieve.
Understood. So this does potentially solve sort of a problem out there, or a gap in the market, as it were. This is not just a tax solution to a problem that isn't out there. This is designed exactly to encourage very real concerns and issues in the world when it comes to succession planning.
Yeah, exactly.
So we just mentioned succession there. David, over to you.
Fine. So what are the possibilities then for succession? Well, there's a trade sale, as we've discussed, for professional practices, and as I said, quite a few sort of solicitors and accountants have looked into the possibility of becoming employee owned. Another possibility is to be sold to a consolidator. Another possibility is a type of management buyout or buy-in, but of course that requires often quite a substantial payments by the management, which they either won't be in a position to make or might not be prepared to make in any case. There's then an IPO, as we've discussed, which has all sorts of associated costs and possibly doesn't give the sellers the exit they want because of the lock-in and all sorts of other things. And finally, there's employee ownership.
Which brings us to where we are today. So let's get into the nuts and bolts as to how these employee ownership trusts work and how we structure them. So there we go, David, all in pretty colours. Do you want to talk us through this?
Yes, I'm by no means an expert on colours, but I think even I can pick up what's on here. So essentially, you'll see the retiring owners sell their shares to the employee ownership trust. And the obvious question here is, how does the employee ownership trust fund the transaction? And there are a number of ways to do that. First of all, and most obviously, it's existing reserves of the company. The company may well have cash on the balance sheet, and it will often be able to pay quite a large amount of that over to the employee trust to be paid to the retiring owners. Now, of course, it's quite unlikely that will cover the full payment. So how do you make up the difference? Well, the company can the company or the employee ownership trust can also borrow money in some circumstances, possibly against assets owned by the company, either real property or just generally against the company's trade going forward. And we're finding there are specialist lenders who will assist with this, but high street banks we're finding are becoming are understanding more about IOTs, and I think generally becoming more inclined to lend in these sort of circumstances. But it's quite a slow process, though. But essentially, almost pretty much whatever form of transaction you go through, in the end, you will have installments and you'll have amounts payable out of future profits.
Okay, so just to be clear, what we're saying is this is effectively paid for out of the existing funds of the company and future profits of the company.
Absolutely.
Which, I mean, there are other ways of structuring these sales where it's paid out of cash within the company, where we've put a holding company on top and we take loan notes. Slightly different tax analysis here. Can I just be clear? My understanding is that this is effectively a gift from the company to the trust. Is that correct, David?
Yes, yes, that's right. Yeah, absolutely. The gift itself is not treated as a distribution for tax purposes. If it were, the whole transaction would fall apart.
And also, we don't recommend it's made by way of a loan from the company to the trust. That can have some negative tax consequences as well.
That's right. Now, there's another point worth making, I think, which is that often, if there is a loan to be taken out, it's best for it to be taken out at the employee ownership trust level and not at the company level. And that's because it's sometimes difficult for the company to make payments to the employee ownership trust of the amount that have been borrowed, and that's sort of for company law purposes relating to distributable amounts and things like that.
Okay, so, and as a seller, I assume there's an arm's length negotiation with the trustees as to how much they should receive for this company.
Yeah, absolutely. Should we look at the capital gains tax?
Okay, so that's the main structure. Let's then link that back and drill down in more detail as to the CGT consequences and the conditions for this. So, all in Finance Act 2014, for those who wish to play along at home, as it were. David, do you want to talk us through the relief? Well, we've already mentioned 0%, but what are the key conditions here?
Right, so as you can imagine, for 0% is a pretty favourable rate. It has quite a few conditions attached to it. The main points, of course, are that the company has to be a trading company or the holding company of a trading group, where you have professional practices and things like that. Obviously, they need to incorporate themselves before they can take advantage of this relief.
And a trading company or a holding company or a trading group, similar to, well, plenty of other definitions, does not to a substantial extent undertake non-trading activities. So you're not going to be completely tainted by a small amount of non-trading activity, but you know, your widget manufacturing company, that's the sort of thing we're talking about here, isn't it?
Yeah, absolutely. Rather than, you know, if you've got sort of major amounts of property being held, then you know you might need to consider or getting enormous rents and things like that. Then yes, you'd obviously be looking at or some sort of investments involved. Then you'd want to be a little bit careful. And obviously, the larger the group, the more you need to be a little bit careful about what you're actually about what each company in your group is getting up to.
Okay, and sort of in our headline there's also a sort of hidden condition that we'll come back to. Must be the sale of a controlling interest. The trust must have control of the company. Yeah. So at least, well, more than 50%, and we'll come back to that a little bit later, time permitting.
Yeah, absolutely. Now, there's a limited participation requirement. It's called the 2/5 ratio, and the 2/5 ratio is that the sellers mustn't, the sellers of 5% or more mustn't represent more than 2/5 of the total employees of the company. And that's quite important because understandably, you're trying to sell the company, you're trying to encourage employee ownership. The point is there has to be a large number of employees involved. If it's obviously the government is thinking, well, if it's just a family company, then there's no particular reason why they should give the relief. So for very small companies, they may need to ensure that ratio is satisfied.
Yeah, as always, there's a few little nuances in the calculation, aren't there? But the broad gist of it is you must genuinely be giving control of this business over to the trust, and the previous owners must largely be walking away. They can retain a small interest, as we've seen, but if they're sort of effectively retaining interest or control in this business, that's not what this relief's designed for.
That's right, exactly. I mean, sometimes sort of people have approached our clients and said, look, here's a whizzy solution. You'll get a 0% tax rate, but everything will carry on exactly as it did before. Yes, there'll be an employee ownership trust, but they won't get involved. And frankly, you'll still be in charge anyway. And you know what could be better? But you know, we've always told people to be very suspicious of these as proposed solutions.
Okay. And yeah, as always, well, the devil's in the detail, isn't it? But that's the headline. And one other condition you mentioned there, David?
Yeah, that's that if the employee ownership trust benefits the employees financially by giving them shares, it has to be on the same terms. And we can look at sort of what constitutes the same terms. Now that essentially says that you either have to give the same number of shares to everybody or amount of cash to everyone, or you can vary it only by reference to salary, length of service, or hours worked. And what happens is, essentially is that you create a grid which gives people, let's say, 1 to 5 points for length of service or salary and hours worked, and then at the end of the grid you'll add up the figures, and then that will give you a total number of points. You'll find out the total number of shares or amount of cash you want to distribute, and this will give you a certain number per point, and then you can give out the money or cash like that. Now, of course, that's only relevant if the employee ownership trust actually has cash to give out, which it won't always. The main circumstances in which that would happen would be if the employee ownership trust sold the company on subsequently, which we can look at. In addition, income tax-free bonuses have to be paid on the same terms. So that's the £3,600 that the company is allowed to give out tax-free. This has to be done on the same terms. They can't just say, well, we're giving it to senior management and not to anybody else. But of course, they could pay additional sums on different terms. So it's not that you're prevented from paying more than £3,600 bonuses to a senior management. It's just that the only bit you'll get tax-free is that amount.
Okay, all right, thank you for that. And just drilling down a bit into rewarding the employees, David.
So there's a table here which I wasn't intending to go through in any huge detail, but basically it discusses here what the company can do, what the employees can be offered in the way of shares, and this goes partly to something we'll discuss later, which is whether the employee ownership trust, once it's bought its shares, is just going to sit on the shares forever, essentially, or whether it's going to start sort of recycling them, in effect, giving them out to employees. And there are some tax efficient plans that allow it to be done. So typically, you can have pure employee ownership trust, which is where 100% of the shares are owned by an employee ownership trust, and then you can have hybrid arrangements where the employees are then brought in by the sort of offer of shares from the employee ownership trust. So you might end up with 15 or 25 employees holding shares in the company, as well as the employee ownership trust, and possibly as well as the sellers. But the important thing to note is that the employee ownership trust always has to hold 51% or more.
Okay, understood. I mean, there is a lot of detail in there, suffice to say. These are not arrangements that should be rushed into. There is plenty to talk about and to think through for consequences for everyone, in particular for the retiring owner. Now, I think we've already touched upon some of these points, David, but are there any other points we should consider for the exiting shareholders?
So we've looked at the fact that it enables the business to continue, the employee's got legacy, and can realise some of the value being built up. I mean, I like to think of it as a soft exit, essentially. If you think of a hard exit as where you sell to a third party, to a third party who imposes all sorts of conditions to decide whether or not you're going to get your money or not. Here, it's a much more sort of consensual transaction, and it's unlikely, for example, that if you missed a payment under the employee ownership trust route, it's unlikely that it would be apocalyptic. By contrast, if you'd sold to a third party, there would be all sorts of conditions involved, and if a payment was missed, or if the company had a very bad 6 months or whatever, then there might be all sorts of problems.
Okay, so that's what's in it for the retiring owner. Just to summarise, what's in it for the employees, David?
Yeah, certainly. I mean, one thing that's possibly worth looking at is that, while it is actually very good for sort of CGT purposes, it's not a good idea to make this your prime reason. In other words, it's not just a matter of saying, well, fantastic, no capital gains tax, that's it, this is the transaction we're going to use, because things can, as we can see later, occasionally go wrong. And where we've seen that there are problems, it's often because the owners have been too tempted by the 0% tax rate and haven't put enough spade work in terms of preparing the company for employee ownership sort of going forward.
Fair enough. Okay, so don't do it purely for tax purposes, I think is your message, particularly if you live in the same village.
Exactly.
But let's just summarise where we've got to for the employees.
Yeah, fine. So what are the benefits for the employees? Well, there's a sustainable ownership structure, and we've been involved in a lot of cases where the employees are actually quite nervous that once the company's been sold off, they'll be sacked as part of sort of cost-cutting measures by the new buyer. That's less likely to happen, of course, with the sort of EOT structure. Greater engagement, and as we can see later, the employee ownership trustee will often have an employee representative, and the employees may well feel that this is someone to whom they can sort of bring their problems, so to speak, and they will actually be sort of represented on the board, which should be a positive thing. There's also the profit share, as we've discussed, the £3,600 tax-free that they can get. And also for them, of course, they've got participation without investment. They are beneficiaries under the employee trust. They haven't had to put any money in from this, but if the company was sold on in 3 or 4 or 5 years or whatever, then they would get a payout, and sometimes quite a substantial payout. And they haven't had to put any money in. So from the employee's point of view, I mean, the important thing is that employees shouldn't expect everything to be different. The deal's done on the Friday, everyone goes out for their sort of celebratory dinner on Friday evening. No one's suggesting that on Monday morning everything will look completely different, but it's more a sort of gradual thing of what the priorities are going to be for the company going forward, and obviously some more tangible benefits for the employees. And if the employee ownership trust does transfer shares to the employees, then they could get, in theory, dividends and capital growth as well. But people are often quite worried about how the employees are going to take this thing. And I always say to them, look, if the company had been sold off before, they wouldn't have expected to get any of the proceeds of sale. There were 3 family shareholders. They wouldn't get anything out of it. They might get a small sort of thank you bonus, but that's it. Whereas going forward, they've now actually got a tangible reason to hope that the company does prosper and get sold off, and they'll benefit from that.
So again, just sort of pulling together what I think we've already talked about, when are these arrangements most suitable, David?
So the important thing is that you need to be confident that employee ownership will work well. It's often people businesses where these work best, and I don't like to think of it as an alternative. I mean, I mentioned before that obviously a lot of sellers would rather just take a large amount of cash and run off, and in those circumstances there may be benefits to that, but often what happens is that isn't on the table. This is actually the EOTs often used, we've found, where the buyers think, or the potential buyers think, we're the only game in town, so we can impose whatever restrictions we want. We can drill down on the price and all sorts of other things. We can cut the the price we're offering you because there's no alternative. And sometimes people come to the employee ownership solution by thinking, well, actually, this is terrible. What can we do about that? And we can say, well, actually, there is an alternative. I don't have to accept your ridiculous conditions because here's an employee ownership trust as a possibility. Management support, I mean, that's quite an important point. You have to have a new tier of people who are interested in taking over. Now, you might think, oh, well, here are some people who are just below director level. I'm sure they'll be delighted to help. I should just caution you, it's often a good idea to discuss it with them. We've had a couple of cases where there were some people whom the existing sellers thought would be delighted to become managers, but actually their main interest was to be home by 6 o'clock. That's when their dinner was on the table, and actually they had no interest, although they were very good at their job, they were not particularly interested in taking over any sort of managerial responsibilities. It had been assumed that they were, but they weren't.
Communication, I think.
Yes, exactly. Communication. Don't assume that people who are good at their job will necessarily want to take on some sort of management position. They won't necessarily. Similarly, employee engagement. You might assume that the employees will be happy to be engaged, but the important thing, really, as Tony says, is to have some communication with them. It's not a good idea to leave your employees in the dark.
Okay. When is it less suitable? Well, that's just the sort of contrast to what we've been talking about, isn't it? We said we needed management buy-in. If you've not got that management buy-in, that's clearly not going to be helpful. We talked about the purchase is funded effectively out of the existing funds of the business plus future profits. We need to have some comfort they are going to be there.
Yes, that's right. I mean, one way that these transactions have gone wrong is where the purchase price is a huge multiple of the profits, and while they might be sort of patting themselves on the back, well, we managed this huge multiple, it does mean that the money will come through much more slowly, and we've seen provisional timetables of 10 or 15 years for the money to come through. We've also seen circumstances where the amount that the company has to pay has basically meant there's no other cash to do anything else in the company, and in fact, sometimes that's caused the entire sort of edifice to come crashing down, just because the payments to be made would be too large. So, while obviously it's nice to get a decent price, you need to be realistic about the amount that can be achieved.
Yeah, it's difficult, isn't it? Because on the one hand, the vendor probably quite rightly wants a fair price for all his hard work, but if he pushes too hard, he might fracture the business that he is wholly dependent on earnings in the future from to pay that consideration. So I imagine it can lead to some difficult conversations down the line if you're not careful.
Exactly, and you need to leave something in the mix basically for the new management to take over and think, well, here's something less for us. If the entire company is in hop for the next 10 years for 90% of its profits, then it's not really going to be of much interest to the management.
And the trustees are meant to sort of sit independently here as well, aren't they? So there's a third party there as well. So it's not just, there are valuation issues that we'll come on into a minute, but also I think you've got to have a firm handle on the expected cash flows of this business to ensure any deal is effectively sustainable in the future.
Absolutely.
Right, so let's pause for breath for a second. We talked before about the fact that the company, to get this tax relief, the trust has to acquire a controlling interest. So that's more than 50%. But that could be anything between 50 and 100%. And there are various considerations there we need to think about as well, aren't there, David?
Yeah, absolutely. So it has to be 51% at least. The clearance is a lot easier where more than 75% is sold. That's the tax clearance. We generally apply to HMRC to get a clearance for all these transactions, and this is the clearance under section 701 to say that the process of sale will be subject to capital gains tax and will not be treated as a transaction in securities.
So you're relying on the safe harbour that's now built into the legislation, is what you're saying. So 75%, you're home and dry in effect.
That's right, exactly.
Anything less than that, you've really got to justify that this is for bona fide commercial reasons, albeit you would have thought that given this is entirely a scheme designed to allow a shareholder to withdraw partially from the business and pass shareholdings to employees, that sounds fairly commercial to me. In your practical experience, do the revenue ask questions where it's between 50 and 75%?
Yes, I think they do ask questions. The sort of thing they'd look at, they might look at the company's sort of dividend policy. If the company hasn't paid any dividends, for 15 years and is now paying out what it would have done as dividends as conveniently 0% cash, and let's say the management were all staying on, and the sort of shareholder agreement to SPA said that they still had pretty much complete control of the company, then I think the revenue would raise some points.
All right, there's nothing particularly new in this. The nub of the legislation has always been, we'll give you lower rates of CGT compared to income tax rates if you are genuinely selling and giving up control.
Correct.
So if it's just dressed up and is not really achieving that, then yes, I take your point. But to be fair, these are exactly the sort of questions we get in any other sort of transaction, be it the sort of holdco and loan note structure we talked about before.
Yeah, absolutely, yes. So you can sell 100%. In some ways, that can be cleaner and potentially avoid a discount, although that's something we'll look at under valuation. Sometimes sellers want to keep a shareholding to show the employees that they still have some skin in the game. So in other words, if the sellers sell 100% of the company and sort of seen leaving the employee drinks in a Rolls Royce or whatever, then people might think, hold on, we've been completely abandoned. So there is something to be said for the sellers keeping a small proportion of the shares just in order to show that they're still invested in the company. From the seller's point of view, it also gives some protection if the company is sold on. Because quite often the sellers will be prepared to take a not especially high price because they're selling to an employee ownership trust, but they'd be quite hacked off if the employee ownership trust sold on a couple of years later at a huge profit and they didn't get any benefit. Where the sellers do sell 100%, you might consider some sort of clause to say that they will receive a proportion of any uplift on any later sale.
Okay, now that's the anti-embarrassment clause.
Exactly.
Okay, so that's when we might enter into these arrangements. Those are some of the key conditions. One of the potential stumbling blocks or key matters that will have to be resolved is what is the trust going to pay for this company? And valuing companies is, well, I think it'd be fair to say, an art rather than a science, although Daniel is free to change my mind on that. Daniel, let's just talk through some of the valuation issues in addressing how much is this company worth, given, as we said, we may be selling anything between 51 and 100% of this business as well, which adds another variable.
Yeah, I think the first thing to say is, I mean, we'll talk in a minute about what you want in the valuation and why you want a valuation, but the important thing to say is that the valuation can and probably needs to be commercial. And what I mean by that is, David already mentioned that it doesn't have to be a cash on completion deal. It's not like a company buying own shares, and a commercial view can be taken. So there's nothing wrong with a valuation stating that the company's worth so much now, and with an earnout or maybe a range of valuations, so that the maximum amount of the earnout can be determined. So we've put on the slide there how far can future performance be factored into the valuation, and it's an important question to consider when considering the valuation of the company. We've put various things for people to consider when they are looking at the valuations. Would there be a minority discount or a majority premium? I mean, well, there can't really be a minority discount if we're selling more than 51%. But would a majority premium be applicable for the amount being sold? And some people would even have a controlling minority discount. It's something to consider. Yeah, lots of interesting things to grapple with.
I mean, we talked there about earnouts, and David, I don't know if you want to add to the party here. Yes, you might sell the company for an agreed fee plus an earnout. That's entirely commercial. From a tax perspective, it does add complications, because when that earnout crystallises, there's a second disposal, not of the shares, but of the earnout right. And that can create, one, valuation issues. How much is that earnout right worth? And two, the crystallisation of that earnout can give rise to a second chargeable event and a further capital gain that I suspect won't benefit from this 0% rate. So valuation is very important here, and adding an earnout, although commercially, I hear you, may be appropriate, does add further complications. I don't know if you want to add any, you got any thoughts on that, David?
No, you're absolutely right. I mean, a true earnout, I think, would be a very difficult thing to do. I think what you'd need to say is that the amount we're receiving is 10 million, but it reduces to 8 million in certain circumstances. But yeah, an earnout in the conventional sense, I think, would probably not work.
Yeah, no, I think you need
very well for tax purposes.
All right, that's almost a separate webinar in its own right. So I think we flagged it up there. Certainly, if there are to be earn-out arrangements, they need to be considered very carefully. But Daniel, back to you.
Yeah, I mean, the point with evaluation is that it's got to be right, and what I mean by that is obviously the trustees of the trust certainly want to make sure that they're not paying too much for the company, because otherwise they'll be in breach of all kinds of duties. And I think if the valuation is wrong the other way, then the revenue might probably ask some interesting questions as well. So although there's no requirement, I think, to obtain an independent valuation, it's certainly worthwhile, and I would have thought the trustees would probably always want an independent valuation to be instructed.
Exactly.
David is nodding, I'd just like to point out, listeners.
Yeah, exactly. I mean, if you're a trustee, remember you've got a fiduciary duty to all your employees, and I think it would be very difficult for you to fulfill that duty unless you had a pretty robust valuation saying that you were paying the right amount for the company. I think the fact that the sellers told you it was worth 10 million, basically, wouldn't really be enough. And as you would be responsible to employees and responsible for helping to run the company going forward, I think it's quite important that the company isn't in hot for huge and unjustifiable amounts.
Okay, enough said. So clearly, valuation important. We get it right, whatever that means. Daniel, do you have any further to add?
Well, I was assuming that you were going to say that you happen to know a very good valuation expert that might be able to help.
Yes. Do we know anyone? Do you, Daniel? Daniel, this is one of the reasons Daniel's here, is because this is exactly the sort of thing you can do, is assist with the valuation process, etc., etc.
So I think in terms of valuations, I mean, typically we would be looking at applying an EBITDA based valuation. Obviously, it's because the company has to be a trading company. David already mentioned that's one of the conditions. So asset-based valuations are unlikely to be useful, and given that we're talking about majority control, dividend-based valuations are also less likely to be relevant. So typically valuations are going to be earnings-based valuations, and these days that obviously typically means EBITDA for the sorts of companies we're talking about.
Okay, and unfortunately, there's no mechanism whereby we can agree this valuation up front with HMRC to get the right number, again, whatever that means. It's only in the context of EMIs where, unless anyone's going to correct me, that is currently possible. So difficult area, I think it'd be fair to say, but I think strongly recommended you seek an independent valuation for everyone's benefit, in particular the trustees, for the vendor, to give him some comfort, to protect you from possible unfortunate HMRC questions down the line. Yes, get a valuation, put it in a drawer. Hopefully you will never need it again, but strongly recommended, and Daniel would of course be delighted to assist. Commercial advertisement over and done with. Right, David, do you have anything further to add on valuations, or should we move on to how we might structure this?
No, the only other point I wanted to make on this is that if you sell the 75%, at some point you then need to sell the other 25%. And the question is how that happens, whether it's part of a general sale of the company, or whether the employee trust, having bought the 75%, will later consider buying the other 25% on the basis of a formula or just on a sort of ad hoc basis. And that's where you might have some sort of minority discount issue applying, because then you need another valuation for that sort of 25% piece.
But certainly cleaner if you can buy the whole shebang.
Yeah. Well, exactly, yes.
Yeah. Okay, right. So how are we going to structure this, David?
Right. So essentially, we've talked about the employee ownership trust as if it's just some sort of random blob, let's say. But actually, it is a trust, and typically it has either individual trustees or more likely a corporate trustee with directors. And typically there'll be 3 or possibly even 5 directors. One of those will be a seller and will be obviously sort of looking out for the seller's interest, particularly where there is consideration still payable. There'll also be an independent director, and the independent director is basically there to ensure sort of fair play between the other directors. It would typically be an accountant, somebody who knows how to look through accounts and generally knows something about the business. Sometimes it's the company, it's someone from the company's existing accountants. Sometimes it's a situation where there's a sort of retired accountant or maybe even a retired FD of the company who's prepared to put in a bit of work, sort of acting as the independent director.
Okay, fair enough.
And there's also an employee representative, typically. Now, how you get this employee representative, this can vary. So if you have a lot of employees, I mean, we've been involved in one company where they've got 200 employees, and they made a big thing about having an election, having election posters up, and it's difficult to imagine in the current circumstances people being enthusiastic about an election. But here they did actually, have hustings and things like that. And the person who won it was very happy, and it was considered to be a big part of employee engagement. But you don't have to have an election; you could just have an appointment by the company. It really just depends. Sometimes you have an employees council or something like that, which reports to the employee. It really just depends on the structure going forward. And the point about the employee ownership trust is, ideally, it will meet sort of quarterly. It will just have a look. It is the major shareholder, but generally it will be a passive shareholder and until things start to go wrong. I mean, a bit like a sale and purchase agreement. Ideally, the company will do well. It will make its contributions to the employee ownership trust, and nobody will actually look at the agreement ever. It's when things start going wrong that the employee ownership trust needs to be able to take over. As we see, the employee trust has to have the right to control the board of directors, so it has to have a big stick, even though it doesn't necessarily need to wield it.
And time marches on, but I think we should just mention that, as in a lot of these cases, there's a lot of hard work that goes into implementing these arrangements. It's not just a sort of sigh at the end and get the champagne out. We do need to be careful going forward. There are so-called disqualifying events that can impact on the tax planning here. If the company ceases to be qualifying, ceases to be a trading company, for example, if you cease to meet some of the conditions we've met within timeframes, then these reliefs can be clawed back or completely lost. Now, probably that's all we've got time for today, David, but are there any particular pitfalls you'd like to flag up at this point?
Well, I mean, it's really just the sort of the risk of how the transaction can go wrong, really. So you can have a decline in profits, which means that the company isn't able to make the contributions on time. Again, failure to engage employees. I've mentioned this a few times, but it is quite an important thing, because if half your employees think, well, I don't like the sound of this, I'm off, obviously that's going to have a substantial effect on the company. Overpromise or under delivery, whether leadership or key people just don't understand what's going on, or they just sort of carry on, or maybe act in a sort of dictatorial sort of situation, then I think it's going to be problematic. I mean, we're involved in one transaction where the people who've just been appointed to the board suddenly decided to order themselves a fleet of executive cars, as to befit their new status as directors, which obviously was quite a substantial cash commitment to the for the company, which the sellers weren't particularly pleased about, because it meant it came out of what they would otherwise have received. So that's just that's probably an extreme example. The other thing is that the retiring owners just don't let go. Where they've agreed to that they'll be stepping down or possibly moving into a non-executive role, they still insist on coming in at 8 o'clock in the morning and getting in everybody's way.
Yeah, there's a balance, isn't there, here? Yeah. You want them on board, as we said before, but you don't want them being overbearing. Okay, enough said. I'll mention one other point just while I remember that we didn't touch upon before, because often it's the silly things that go wrong. You actually have to claim this relief, don't you? It's not automatic. So people shouldn't assume just because we've done and met all the conditions we've talked about, you can just ignore the gain you've made on the sale of your shares in your tax return. You have to formally claim the relief. So important you actually tick the right box, as it were. So there you go. Just one of the, well, I suppose it is a risk, isn't it? If you don't do it, you might have an unexpected tax bill. There you go. Right, we're nearly there. Just to finish off, David, why don't you talk us through the key steps here?
Okay, so very briefly, if you were thinking of doing an employee ownership transaction, how would you do it? Typically, you'd start off by getting some sort of valuation. If nothing else, just saying, I think the point is that you might be prepared to do the transaction at 8 million, but not at 2 million. So you'd want to get some sort of valuation, even if it's only an indicative one, in order to ensure that it's worth having a go at the transaction. So what price can the company fund, and over what time period? You might speak to your bank or whatever about external funding. Decide what proportion of the company you're going to sell. It said 51, 75, 100%. Decide who's going to run the employee ownership trust, and also decide whether it's going to be 100% owned company, or you're going to put in some sort of share scheme for employees. And those are the sort of decisions that you'd normally want to make at the beginning before you went ahead with the transaction.
Okay, so that's step one. Step two, hopefully, once we've got over those hurdles, the implementation.
So in effect, what transactions would you actually need? Well, you'd need a sale and purchase agreement. That's not quite like the sort of 100-page example with 16 schedules that you'd see if you were selling to a third party, but there will be sort of limited warranties given. There'll be a limited amount of due diligence done, a bit like on an MBO. Some financing documents, particularly if there are people lending money on the transaction. There'd also be a shareholder agreement between the employee trust and the sellers if the sale is less than 100%, and that would set out things such as where the sellers have a veto over things going forward. The sellers wouldn't have too many vetoes, because obviously the whole point is that the sellers aren't involved anymore. But you would typically, if there was going to be a major change in the business or maybe a sale on, the sellers would still have a veto right.
David, pause for breath. We have a question.
Right.
You've all been very quiet today. The question is, from our old friend, is CGT relief available on a second stroke subsequent sale of shares to the OT? So I think what Margarita is asking, if we sell, say, 75% tranche one, and then the trust buys the final 25%, can we still get the 0% rate on that second sale?
No, you'd be paying 10%, and you'd be paying 10% unless it happened in the same tax year.
Okay, so I think that's a very important point, and thank you for that question.
So assuming obviously you're still a director or an officer of the company. If you weren't, then you might be talking about 20% tax rate, but no, the 0% tax rate wouldn't apply here.
Okay, thank you for that question. Right. So where were we?
So
we've got to thank you. Sorry, go on.
Thank you. So yeah, HMRC clearances we would want to put together. Where you're selling 75% or more, it should be something of a formality, and you typically send off the clearance, and then you'd actually get on with producing the documents anyway. If it was a more difficult clearance, you might wait to see what the revenue said, because they might impose certain conditions on how the transaction would work.
So look, this is, I think it'd be fair to say, a complex transaction. You've got the trustees, you need to have people like yourselves advising on the legal aspects. You'd need someone like Daniel helping you with the valuation. What sort of time frames would you suggest to implement such arrangements?
We would say typically 3 to 4 months from start. If you needed to do it more quickly, then you could, but it would require everyone to get their ducks in a row.
Yeah, I mean, our experience at the moment is that clearances are taking pretty much the full 30 days. Absolutely, and often it's a question at the end of those 30 days, I suspect, just to give some answer within that time frame as they are required to, rather than because there are actual substantive issues they need to get to the bottom of. So yeah, it shouldn't be rushed, I think, is the bottom line. And you're not going to be able to do this before the election if it's next month, I suspect. But
No, that's
I'm
right.
sure David would try, wouldn't you?
Absolutely, but no, I think Christmas. I think Christmas would be more realistic as a possibility.
It'll be all over by Christmas. I've heard that one before. Okay.
Absolutely. So apart from that, it's just drafting a trust deed. It's a sale and purchase agreement, as we've said, any finance documents, and then obviously it's the communication point. Get the support of the leadership team and make sure that you keep employees in the loop.
And that, as they say, I think is that. Thank you all very much for listening. There are our contact details. I'm sorry we've not put up a picture of Daniel. We didn't want to scare the kids.
Yeah, it's fine. You left out the best looking ones, so don't worry about it.
But you can find Daniel's contact details on BKL's website, which the address is there. David's details are there. I'm sure he'd be delighted to talk to any of you who are thinking about implementing employee ownership trusts, either for your own companies or if you're acting on behalf of others. It is a complex area, but I think we will see these arrangements becoming more and more popular. Indeed, as we said before, they're certainly gaining more traction as we speak, as they sort of come into people's awareness. But lots to think about, as I hope we've touched upon, and an awful lot of detail behind all of that. So we'd be happy to assist further. So thank you all. We will circulate a copy of this webinar. That should come out to you in the next day or two. Feel free to re-listen if you can't sleep. But otherwise, we'll leave you to the test match. Let's hope Smith is out. No? Okay. Oh, dear. Thank you for listening. We are doing a follow-up webinar on VAT and property, I believe, at the end of this month. We're cramming them in, so we'll be sending out details of that shortly, and we very much hope you can join us for that. So for now, thank you from me. Thank you for your time. Goodbye.
Bye.
Bye.
Bye.